Hey everybody, I hope you all are doing good. In this video, I'll be sharing with you how simple and straightforward investing and consistently growing in the stock market can really be. When talking about actually investing in the markets, actively investing in the markets the right way, there are 5 major steps involved into it. And in this video, I'll be sharing all these 5 steps, and all these 5 steps are laid out in chronological order. So just go along in a sequence, and even when you implement these steps, you'll be looking to implement them all in these 5 sequential order. And stick around to the video till the end, because the last step that I'm about to mention, which in the sequence, it is one of the most important and also one of the most overlooked steps when it comes to investing. And if you really just miss this step, and if you don't really take it so seriously, this one last step that I'll be mentioning in this video, you simply won't be able to get the returns or results in your own portfolio. But before we get on to the video, if you're a returning viewer, good to have you back. And if you're somebody who's new to this channel, well, welcome. My name is Shaun. I'm an active US equities trader as well as investor in the stock market. And on this channel, we talk all about investing and trading, the goods, the bads, the rights, the wrong, and everything in between. So if you're interested, consider subscribing, and while you're at it, might as well hit the like button. The very first thing when we're looking to invest in the stock market and be a little bit active and try to extract a larger percentage gains for our portfolio, this is something that I don't really hear a lot of people even consider. And the very first step is now, when people generally talk to me or ask me about investing or how to invest or what to invest in the stock market, or even when they're chatting among themselves, they're usually referring that what's the best stock to buy, or when they're browsing websites, they're usually considering like what's the best stock to invest in or short or go long on, but they're never really considering market conditions. And we always have to understand that what are the market conditions? Is it a bullish market? Is it a bearish market? Is it a market that is moving sideways? And not just that, we also have to understand what is the major theme or major underlying sort of fundamentals that are really the primary driving force of this market conditions. If, let's say, if it's a bullish market, why is it a bullish market? Maybe are there rate cuts being taken place, or interest rate getting cut? That is the key driver. Or maybe the economy is doing really well, or maybe there's a lot of jobs in the market and people are making a lot of money, a lot of income, and there's a lot of prosperity in the economy going on, and overall it's a very healthy economy, and most companies are also putting out great earning numbers. So that is one example. Or if it's a bearish market, why is it bearish? Is there a lot of fundamental, real, solid reasons for the economy to be doing poorly, or is there just a lot of fear in the market? So we really have to dig a little bit deeper and understand. If it sounds like a little bit intimidating trying to catch up with CPI, PPI, interest rates, and macroeconomic themes, what are they going on and what's really happening in the market? If you're somebody who's thinking like, okay, I'm not so sure if I know these things already, I would say that those people are a little bit in the minority these days. What I find is that most people already have maybe 75% of the knowledge about the macroeconomic themes and understanding what's really going on in the market. And they simply just need to learn how to take that information and knowledge that they already have. They simply need to learn how to implement that in market and also just profit out of that, right? So and if you're somebody who has no idea about these macro, or you don't know how to take this information and apply it to your portfolio and essentially benefit from this, there's a link in the description below. Feel free to check it out. There's a program which I call Investor's Edge. And in that program, you can learn everything about trading as well as investing the right way, fundamentals, and so much more, the strategies. And on top of that, you also get a hands-on one-on-one coaching with me directly, as well as we provide you the research on a weekly basis so you can catch up with the market, exactly what's really happening and what do you need to pay attention. And on top of that, we also just shortlist the fundamentally most strongest stocks for you that are more likely to make big moves, big, large percentage moves. So basically, you don't even need to have anything to do. Everything is done for you. And you're basically in a position where you can literally just grow your portfolio in 5 minutes a day. So if you're interested, feel free to check it out. There's a link in the description, the very first link. That's going to take you to my website. You can read about it. And if it sounds like you'd be interested in it, feel free to schedule a call with me through that website. But getting back to it, as I was saying, most people already have some level of idea. And even if they don't, these are very easily digestible information that we can quickly learn the macroeconomic fundamentals. And the next major question to ask yourself would be, how can I stay up to date with the market, or where is it that I can fetch this information and stay up to date in the market? And there are so many sources these days, so many different websites, finance websites especially, and it's a lot more easier than ever these days to try and keep up with everything that's going on. And you can just sign up to the website, register your free email, and they'll just keep sending you email updates. Depending on who's watching, you can sign up to something paid. Obviously, as you can understand, paid ones are going to have a lot more information for you, and the free ones are going to be having a little bit less information. But in my experience, I think free versions are just completely fine. You can just go to any finance website of your choice, just sign up, and just give them all the information on what sort of updates would you like to receive, and try to keep up with the economy and what's really going on, and what are the major themes that are affecting the overall market and the economic conditions. And one more thing I'd like to add, when you're trying to take in all this information and when you're reading articles and blogs about the market updates, try to stay away from opinions of analysts, right? Try to just consume the facts and the figures, because numbers don't really lie. And on top of that, every investor, I feel, they should know and learn this investing and be able to do it on their own. Basically, they should be self-sufficient. And what I'd recommend is taking all this information, whatever's happening, and be able to form your own opinions. And additionally, one more trap a lot of people tend to fall into when they're taking opinions of analysts, or somebody who's a finance professional, whatever it is, wherever they're getting their opinions from. Sometimes it's, even if they have formed their own thesis, their own opinions, sometimes they kind of lose confidence if their own thesis conflicts with somebody who's, let's say, a finance professional, whatever it is, and they lose confidence in their own thesis. Or sometimes if they both have similar sort of thesis formed up, now they're becoming a lot more overconfident, and as a result, sometimes they can be a little bit more aggressive in the market, and it really ends up hurting the portfolio rather than generating them larger gains. So just stay away from opinions. Try to take in only the facts and figures and form your own opinions. Additionally, I wanted to mention about the market conditions being the very first step in any investor's sort of task to do when they're looking to invest in the markets. And the reason for market conditions to be the very first and primary step is because 80 to 90% stocks, regardless of what their sort of reason to be trending up or down is, 80 to 90% of stocks still follow the overall market. So if the overall market is bullish, majority of stocks are going to be bullish or trending up. And moving on to the numbers, second is as investors, we really have to understand the fundamentals. And when it comes to fundamentals, a lot of investors I've spoken to, they tend to be very intimidated of, this is just too much work, or it doesn't look as sexy, or it doesn't look so interesting. Well, investing, first of all, is by default a very, very boring job. So, there you have it for you. Something that not a lot of people would tell you. But yeah, investing and trading is actually a very, very boring sort of job. And the only reason to be doing it is because it's a good practice to do, and we all want to keep on growing our wealth steadily after. I'm hoping that you're trying to do the same thing. But coming back to matter at hand, fundamentals are sort of the driving force of any single stock. When the market conditions are good, the stocks are going to follow. But if this company is fundamentally a strong stock, and when I say fundamentally strong, they're a good business, they're profitable business, their sales are on point, their profits are on point, everything is on point, those stocks are always going to outperform the average market and other stocks in the stock market. And also, a lot of people, when they talk about fundamentals, they also tend to have this idea that what we see in movies. I remember there was a movie where I think it was Bradley Cooper, and he takes a drug and he all of a sudden gets really smart and really active. And in those movies, they're talking about there's a merger, there's a PR, that means this, that means that. And they're trying to come up with like all sorts of conclusion, and the guy looks like a really smart guy. The fundamentals when we're trying to pick the best stocks, they really don't have to be overcomplicated, and the easiest fundamentals to really pay attention, and also the most profitable fundamentals to really pay attention to, is earnings. We really don't have to try and be like the Bradley Cooper. I think those things only look good in Hollywood, but when it comes to reality, we just can't simply ignore everything, and we really don't need to be extremely smart. In fact, more often than not, when people try to be extremely smart or over smart, it only ends up turning out really badly for them. So just stick to the old school stuff. Is the stock, is the business a good business overall? And what qualifies for me as a good business in the stock market would be, is the company making money? Is the company making sales? And are those sales numbers growing? And if the sales numbers are growing, is the profitability also growing with them? Are they capturing more of a market share? How are they in the overall sector? Are they one of the leading names, or are they just another average company? And maybe there's another better company in that sector, and they're doing a lot better than this existing stock that we found. So we really have to understand. And it also doesn't has to be like too much work, especially these days where you have so many softwares and tools that we can easily pick out stocks which are consistently growing in sales, consistently growing in profitability, in revenue, and all sorts of factors, right? So and also the debt shouldn't be too high. So basically, overall, it should be a healthy business altogether. Number three is technicals. Now, there are a lot of investors who are completely in the bracket of I'm a technical only, I'm a fundamental only kind of guy. But nowadays, I think both of these things have proven themselves to be reliable enough. And I would encourage any investor to also look at technical, because the purpose of technical analysis is not to base your investment decision on them, because technical analysis is not really a driving force of any market. It doesn't really have to be stock market as well. It could be crypto, it could be stocks, it could be forex, it could be anything else. Fundamentals are the key driving factor for any asset to go up or down, to attract demand or supply, and as a byproduct of that asset is going to trend up or lower. But technicals simply help us time the market. When is the right time to enter? When is the right time to exit? And I'll be clarifying this timing the market in just a second, because a lot of people also, when I talk about timing, a lot of people are thinking that, picking tops or picking bottoms, those are some things that you really can't do. If you do that, that's only luck. But timing the market based on technical analysis is a little different, which I'll just go in that in a second. But one thing I want to mention before even going into timing aspect of it, and this is something a lot of investors seem to struggle. I think a lot of investors know about this, but they don't really, are able to implement it, and they really struggle to, digest this information, implement that information. They are unable to accept that no opportunity is 100% guaranteed winner. And a lot of people know it, but they don't really implement it, or are able to implement it and understand it. No wonder we see a lot of people just averaging in, or just blowing up their accounts sometimes here and there. But yeah, so technicals also help us time the market, and also just really understanding that no opportunities is guaranteed. So technical also tell us that when is it that we are completely wrong on the trade. So our technical analysis should really help us tell that, okay, this trade, we might be correct about the fundamentals, we might be correct about the overall market conditions being right, but as of now, the market is just not doing what we expect it to do. And technical analysis also is a language, basically a language of the market, and we really have to understand how to read the language of the market, so we can understand and interpret and get in the market at the right time, and really not involve ourselves in the market right time. And also, when it comes to technical, in simply put, I think if the market is like this, going somewhere like this, and we think it is a good idea, I think this really doesn't mean anything, because this is still a good idea. Maybe the market conditions are right, fundamentals are right, but if the market starts to trend a little bit lower, this is not somewhere when we are looking to enter the market. We are waiting for the bottom to happen and start the reversal, and this is where we might look to enter. And this is only thing is technicals are the only tool that can allow us to see what's really going on. Is the market trending up, down? Is it starting to turn? And is the turn sort of confirmed? And even if we profit, when is the market likely to turn, or has already turned, and how can we know about it right around here somewhere, when the market has taken a turn? So maybe we can take our profits. So we really have to learn and understand technical analysis, and we don't even need to rely so much on the fancy indicators. In fact, I personally do not like to use indicators. I like to use the old school trend line and support. I think they're just more than enough, and they provide a lot more certainty, because now you have the visuals rather than a mathematical formula dictating what you should or should not be doing in the markets. So that's number 3, understanding technicals and knowing the right way to use the technicals. And also, since no single opportunity is ever going to produce 100% guaranteed returns in the markets, technicals also really help us know when to exit, when the markets language are telling us that we are simply wrong, at least as of now. So we're better off just getting out of the market. Next major step in investing and investing the right way is number 4, risk management. And risk management is by far one of the most important things, if not the most. Well, all these major steps that I'm talking about, these are all the majors. And on a side note, a lot of investors or even traders tend to just focus on so many little details and minor things that it really just keeps them from growing and seeing a level of success that they would actually appreciate in their account. Encouragement to you would be to focus on major things rather than minor things, because if you focus and get good at major things, minor things are eventually just going to take care of themselves. But coming back to the matter at hand, which is risk management, like I was saying earlier, no one opportunity or any opportunity in the market that you get today or tomorrow or 10 years from now, it's going to produce 100% guaranteed successful results. So it's safe to say that do not risk too much or put all your eggs in one basket and risk into some opportunity, because I've actually seen a lot of tweets and other people saying that I took my life savings and I took a loan and I invested in Nvidia and I lost all of that money. So no opportunity is that good where it's worth risking your house for. Or also, even if it's not something as dramatic as that, no single investment or investment idea is good enough for you to lose your sleep over it. So always risk in a level where your account or where your strategy, where your comfort zone sort of allows for it. Just never risk too much where you're losing your sleep. And also, do not risk too little, because as investors in the market, we are getting paid to risk our capital in the markets. So risk appropriately. Don't risk too much, obviously, but also do not risk too little where the stock just goes up by 200% and your portfolio only increases by 5%. So, right. So just have a bit of a balance over there. And additionally, I want to mention about risk management, and it is just so overlooked or so misunderstood, is that 1% risk rule of your portfolio. And I'm not a huge fan of that sort of 1% static rule, because I think it's oversimplifying a complex concept of risk management. Let's say you have a strategy that produces 80% win rate. Are you still going to feel wise risking only 1% because 80% win rate is too high? And what if your strategy produces 30% win rate, but the risk to reward ratio is significantly higher, maybe like 1:8, 1:10? In that case, I think if you just stay with 1% risk rule, you're going to eventually blow up your account. Risk percentage really has to come, or really has to be dictated from your strategy and stats that you've generated. And additionally, the second thing I would say, a lot of, or significantly misunderstood by a lot of investors or traders or people who dabble into the market, is that if I take a position and I'm only risking $500, that's it. That is the only risk. And let's say I'm able to move my stops to break even. Now it's a free trade. So I think that is just, again, oversimplifying the whole thing. And what I mean by that is, I think this is how risk management should really be looked at. Let's say it is something trending higher. You end up buying over here, and your stops were somewhere over here. So stop, entry, right? And after a while, since the market just moved up over here, you're able to move your stops right around here. So at break even, right? But what about this floating P&L? All this, you're still risking that floating P&L. And you, till the time you're involved in the market, until the time you have an open position in the market, you have to make sure that you're managing the position actively. And when you're talking about investing and trying to hold positions for 2 weeks to a few months, it actively managing really looks like just taking a look at your portfolio for 5 minutes a day, and that's what it really means. But the moment anything changes, right, this is where you should be able to act if the market really calls for it, and you have to have rules. But like I was saying, risk management can't really be just static, and do not oversimplify it. Try to actively manage risk, and that is what actively managing risk looks like. Also keeping a note of the floating P&L, the floating loss or the floating profit. Last but not the least, step 5, and this is probably the most important step. And although like all these steps that I mentioned are all pretty important, but this step 5 is probably the least spoken or the least accounted for. They learn all this stuff that we've already spoken about, and they're thinking that why are the results not following? And this is why. Number 5, skill development. Now, all these things that we've spoken about so far, do not expect it to be like, okay, I just taken all the information I learned and now I'm just ready to go. All this stuff takes time. It takes repetition. It takes a bit of experience, bit of a screen time. And when we're talking about investing and holding positions for a few weeks to few months, things are moving a little bit more slower compared to if you were somebody who's looking to actively day trade. Things are a lot more slower, and as a result of that, markets are a lot more easier, forgiving, and also the skill development can happen a lot more faster because you have a lot more time to process and conclude all the information that you gather, and take a decision based off of that information. But you still have to learn how to develop your patience on holding your winners longer or holding your losers as well, not letting them go past your stop losses. But one of the common mistakes that I used to make is that if it's not moving immediately in my favor, I would just not even let it have a bit of wiggle room, even though my stop would be slightly lower. And if it just price just comes a little halfway there, I would just exit. And the markets would just turn and go back all the way to my target, and I would just exit a lot earlier. So you have to develop the skill and ability to stay patient, and also not to mention all the things that we've spoken about, understanding market conditions, fundamentals, technicals, and taking all this information and coming into a conclusion that this is a good investment decision for me and I need to enter this stock. Coming to a conclusion of this information and taking a decision and really putting your capital onto it and making capital work is a skill, and just not really deviating from your own plan, not risking too much or not getting emotionally caught up, and not making emotional mistakes because you were feeling something or because you heard somebody else's opinion, and now your own thesis, you're just messing up your own thesis and what you initially thought about the investment yourself. So I think it's a skill to keep yourself distracted. And when we talk about active trading, Yeah, those skills need a lot more, significantly lot more screen time, and sometimes traders do take years. But when you're talking about investing, you can't be taking more than a year or 2 years. I think it's just a few months should be good enough for you to be good enough as an investor and follow these steps and make good investment decisions and kind of grow your portfolio in a consistent manner. And even when you try to follow all these steps properly every single time, I think a lot of people, even when they're looking to follow all these steps, and where a lot of investors tend to go wrong is they're doing everything right, they're following all these steps, they start to see some results, but then all of a sudden they hear a tip or hear a rumor, or all of a sudden something out of the blue just comes at them, and now they just get caught up in that information and they completely forget the results, and they just take an investment which just wasn't good to begin with, and they end up investing in that stock and doesn't really pan out, and now they're getting all emotional and all that. So just stay away from any of these. And whenever you're looking to invest in any stock, always just look to follow all these steps in chronological order. Check the market conditions, check the fundamentals are right, and look for the technicals to just time the market better. Make sure your risk is on point and you're actively managing your risk, and make sure that your skills are on point and you're able to take the right decision in the moment when it really counts, and you have enough skills, or you're prepared to take the right action when the time sort of calls for it. So there you have it. Those are the 5 major steps. And if you're looking to invest in stocks, if you simply just follow all these 5 steps every single time you're looking to invest in any stock, today, tomorrow, or regardless of the market conditions, if you simply stick to these 5 steps and keep following them every single time, uh, you just won't be able to help but grow your portfolio. In the beginning, it might even end up seeming a little bit confusing that if you read an article or read what's really going on in the markets, you're not completely understanding what's the macroeconomic theme, or you're looking at the fundamentals of the stock, you're not completely understanding the big picture or technicals. Just hang in there, just practice, and it's going to take a little bit of time. Nothing we learn and pick up overnight and ends up generating results. But if you just give it a couple of months, I think you'll be much ahead of most people. And if you simply learn to just stick with these 5 steps and follow these steps in sequence every single time, you're going to be constantly finding yourself investing in stocks that end up being the biggest winners of the stock market. So there you have it, guys. Hopefully you gained a ton of clarity from this video. If you did, like, subscribe, and with that, sayonara. I'll see you in the next one. Take it easy.